All right, let's connect then with Mukul Kochhar, who is now joining in on the show to chat about his outlook for the equity markets. Mukul, let's start off by talking about the slowdown that we're seeing within the consumption space. Now, added to the woes is Escorts, who is expecting a weak Q1, 5 to 8% tractor growth for FY20 vis-a-vis the double-digit growth. How unnerved are you by this, or how unnerved should investors really be?
There are two parts to the consumption basket. One is discretionary consumption, which itself is divided in two parts, and the other is staples. Let's talk about discretionary first. Discretionary, the bigger basket is vehicles, and then you have appliances and white goods on the other hand. On the vehicle side, let's talk about that. That's where the slowdown is very, very pronounced. But there are many factors that play there, not just a consumer, sentiment. The first is that regulatory intervention or external interventions has been very, very substantial in the last 4 or 5 years. Starting with demonetization, which was the first, I would say, blow to the sector. Then came BS4 transition in rapid succession. Post that, you had the insurance law changes, and then finally, we're getting into BS6 again. So the vehicle sector per se has its own dynamics. On top of that, you can add ride sharing, which has had a very substantial cyclical element. The last few years, ride sharing was very strong. The fleets were getting built up. That build-up is getting wound down, so that itself has taken a few percentage points off at least the car segment. So there's not as much consumer involved in the vehicle segment as factors that came in rapid succession over the last 4 or 5 years. If you look at the white goods space, there the demand has been fairly robust. I mean, barring a few inventory-driven slowdowns here and there, demand has been good despite strong comps every year, and stocks are reflecting that. All the stocks which are in the white goods space, they're at all-time highs, and they're doing very well. Come to FMCG. FMCG has actually, even in this cycle, given 7 to 8% growth on fairly strong comps. So FMCG staples is also in fairly robust space. Where consumption slowdown is very pronounced is in vehicles, and there it's more than just the consumer. Even if you look at RBI's survey on consumer sentiment, actually that is also looking fairly robust. So while a lot is being made out of the consumer slowdown, I think it's more related to what really happened extraneous to the consumer, especially in the vehicle space.
That's the take coming in on the overall consumer space, but let's also understand what exactly your view is when it comes to IT. We have been speaking with a lot of the managements, and they seem to be talking about how their focus is clearly going to be on digital, with the overall rupee tailwind as well. How have you read into the earnings that we've got? Because, Mukul, it seems that within the IT space, at least for the large caps, it's been a very divergent set for the IT majors. So what is your pecking order here?
See, IT, of course, there's TCS, where execution has been fairly solid over the last few years. I'm sorry. TCS not only has delivered very substantial or better than peers revenue growth, they've always also managed to keep their margins intact. I think part of the reason why TCS has fared so strongly is that they've been able to diversify very well away from the US. US margins are a little lower than outside. So TCS has benefited from excellent execution. But valuations are reflecting that. TCS is today at 21 times earnings, which is high relative to its own history. It's high relative to the rest of the peers. So TCS becomes a slightly difficult play just because of where it is, whereas execution is very good. The rest of the pack, if you come about, then you have Infosys, HCL Tech, and Tech Mahindra in the large cap space. Between these space, we prefer companies with slightly lower multiples. And the reason why I'm saying that is that execution is fairly difficult to sort of separate in all these pack. Infosys may be a tad better than the rest, but execution here is slightly spotty. Margins have been under pressure despite a strong rupee. Infosys wasn't able to sort of deliver on despite a weak rupee. Sorry, Infosys wasn't able to deliver on margin the last year and early this year. So there we are preferring actually low valuation stocks where you get comfort if there is a margin miss. Having said that, going forward, you've had a very strong. The entire pack was very strong performing last year as if you look at the stock prices. This year also has not been too shabby. Going forward, I think you'll need a little bit of a help from the rupee, and here what happens in the upcoming elections will play some role, especially when it comes to performance of defensives like technology. So I think things are fairly priced right now, but as a defense again any weakness in rupee, the sector is still very, very attractive.
I want to bring one joker in the pack, so to speak, and that's IndusInd Bank. It's after the ILNFS issue, it's turning out to be a rather rough or a patchy run for IndusInd Bank. It's nowhere close to what Axis Bank and, for that matter, HDFC Bank have done. Let's look at the 1 year chart, or 6 months actually. I mean, ILNFS happened in September, to 6-8 months would be a good comparison. In the last 6 months, IndusInd Bank has been flat. It's almost flat like a pancake. It's just given you no returns. But during that same time, Axis Bank, which comes from low base, is up 35%. ICICI Bank is a massive outperformer. HDFC Bank is 17% higher. So within the private banking space, IndusInd Bank is underperforming. Do you think there is an opportunity here, Mukul? IndusInd Bank is getting unnecessarily punished because of the ILNFS exposure, or this exposure is like opening a Pandora box and it will be, peeling and more peeling like a onion?
I don't, let me say, I don't think it's unnecessary. I mean, I think IndusInd Bank was very, very expensive going into, what happened with ILFS. ILFS was a clear misstep from the existing management, who's built a very good track record. And clearly that multiple came under pressure because of that misstep. But if you look at, the broader story, there are other issues as well. While there are positives, there are other issues as well. One is granularity of their CASA. The liability franchise actually is not as strong as the larger banks. So in an environment where liability is becoming important because of the lack of deposit growth in the system and some pressure around wholesale borrowing, I think it's natural for IndusInd Bank to be under pressure, especially coming from where it was, where multiples were very, very high. The last point I would like to bring in is, while IndusInd Bank's book is cleaner than the rest, I think it is not as pristine as some of the other larger banks. So that suspicion also is at play, and therefore IndusInd is somewhat under pressure. What will help IndusInd is what will help IndusInd is the closing of the deal with Hafin, where they will pick up some NIM, but I think high valuations and some of these missteps is going to cost IndusInd.
Well, let's get right back then to Mukul's conversation. Mukul, let's talk about what happened with Vedanta in the quarter gone by. That one-time gain definitely lifted the profits, but you had, the copper smelter closure, and that really seems to have taken a toll on the overall revenues. How have you read into the earnings for Vedanta?
Yeah, I'm sorry, we're not covering this stock yet. It's actually honestly quite complicated to give an uninformed view, so I'm sorry, I'll pass on that one.
Another stock I need to flag off is NTPC. We don't talk about it. It's considered to be one of those stocks which do not excite traders. It's one of those stocks which has given you market outperforming returns, so it's not on everyone's radar. Now, HDFC Mutual Fund apparently has 2-3% equity in this one. We understand by looking at the portfolios of ICICI Prudential, AMC, that they also have a very large sizable exposure in Power Grid and NTPC. Let's look at the 1 year chart of NTPC, just the 1 year chart, not like a 3 year chart. On a 3-5 year chart, it's been a block of an underperformer there, but it is outperforming market and it's getting unnoticed because it does not give you a 5-6-10% spike. That's a 52-week chart. Let's weave it around and spin it around. I think there was a bonus also in it. And this year the stock is done decent returns in an otherwise choppy environment. Mukul, is there money to be made in NTPC, PFC, REC, Power Grid?
Yeah, unfortunately, we don't cover a lot of these, but I'll give you some view out here. So, these stocks are, especially the stocks you named, Power Finance and REC, let's take an example of those exceptionally cheap stocks. There is some concern on sustainability of earnings as and when the state electricity boards do get reformed. That is one. Will they need so much debt coming from the central institutions? And secondly, is there going to be another reset on the rates they're getting, as happened the last time? But exceptionally cheap stocks. So if somebody is looking for value buying opportunities, they should consider. NTPC, Power Grid are utilities, regulated return entities with high visibility on earnings. So in a time where there is reasonable uncertainty coming, I feel, given where I think the election scenario may pan out on 23rd. In that environment, some defensives like NTPC and Power Grid, which are trading at all-time low valuations on price to book, which is the relevant metric out here since these are regulated return entities, it would make sense to take a look at those as purely as defensive stocks which are trading at all-time low valuations.
Okay. I just want to mark some of the pharma names, and of course the repercussions are only going to be felt as we step into trade today. But there's news out in MYLAN. It's cracked in excess of 20% overnight. It is, remember, the world's biggest maker of generic drugs, which saw the biggest drop it has in the last 19 years. The results have managed to miss the consensus estimates, lower volumes, strong US dollar hit revenues as well for them. EU revenue, though, has been significantly below, and the EBITDA has been at best in line. So this is coming in that sense from the global leader. And yes, repercussions are to be felt for Indian generic manufacturers as well. Mukul, how is it that you're going to read into MYLAN's commentary and the fact that the leader in the globe is actually seeing such a big crack when it comes to its Q4 performance?
So we, as a house on pharmaceuticals, have been fairly sort of, I would say cautious especially on the global back. Two things. One is, of course, as you mentioned, performance is not the same as it used to be given the regulatory changes around approval of drugs in the US, which is the biggest export market and one of the more profitable markets. So that dynamic has turned, and we believe valuations are not reflecting that change completely yet. So as a house, especially on the export side, on the pharma side, we have been a little concerned, and this is part of the play that where sometimes earnings are too dependent on single drugs and or a few drugs, and therefore it introduces volatility in earnings, and we don't think valuations right now reflecting this dynamic.
Look at the stock price of REPRO. It has completely plunged. The so-called halo stocks of 2017-18, where low-cost housing was the pet theme, everyone thought that Indians will only buy houses, and irrespective of how the borrowing was done, HFC companies will continue to grow. Mukul, are you hunting for opportunities in the NBFC space? If yes, which one?
Yes, of course. I mean, it's not like I'm not a believer that NBFCs as a pack is going to sort of die out. Of course, you need two things, I guess, when you have NBFCs. You can't do a wholesale business when you have wholesale borrowing as well. So what I mean to say is that you need more granular asset book which can be balanced by wholesale borrowing if you want to have a sustainable long-run business, especially that can be listed in equity markets. So there are many players which have a sustainable liability franchise with fairly good, fairly reasonable asset book, which are backed by a good sort of brand or a good group where liability funding will not be a problem. And these are some long-term plays like Bajaj Finance, HDFC Group. In the housing finance space, you have a small company called Canfin, Can Fin Homes. So all these are sustainable franchises, and when we look at them all the time, we may go in and out. Chola is another very, very good name down south in vehicle finance, Mahindra Financial Services. We may be in and out of these names depending on valuation, but these are very, very robust long-term franchises.
Thank you very much. Appreciate your time, Mukul, and appreciate your thoughts.